Good morning, good afternoon, and good evening to you all. This is Rustin Edwards, based in Geneva, with my illustrious traveling co-host, Mr. Matt Stanley, and welcome to another fun-filled, exciting edition of the Smoking Barrel.
Got me
Top of the
pumped.
morning to you there, Matthew, or I should say top of the evening to you.
Top of the afternoon to you, but we got there. I've got my palm tree shirt on just because, if I'm brutally honest, the other ones don't fit because barely wear a suit anymore. But it's because they got shrunk, if anyone asks. Someone shrunk them. Evil. It's nothing to do with an excessive Christmas. Anyway, no, greetings from Malaysia. Um, I Last time I would have seen most people was when I was in Singapore for APEC. And then I welcomed a son to the world, little Charlie, and I didn't travel anywhere. And then, um, yeah, that was last year, and now the new year is upon us, and travel I will be. So I'm in Kuala Lumpur right now. It's 20 past one.
So you'll be contributing to the overall global jet demand forecast that's been put out by the IEA and the EIA and the OPEC greatly then this year.
Yeah, and I can tell you the peak oil demand is not there yet. No, I was in a meeting this morning. We were talking about peak oil demand or where people see demand because, we're touching it later, whereas Brent has been trading all year, 2024, we're 22nd of Jan today, so 3 weeks in, around $78 a barrel. It's been exceptionally narrow. We'll get onto reasons why, but you see the construction here and you see the construction where, back in the Middle East, obviously where I have lived for the best part of 15 years now. And you realize, not 12 years, 13 years, sorry, I'm losing myself. And you realize just how much construction there is here. It's just incredible. And, what's happening in Thailand and Vietnam and places where certain oil companies based here are looking at where demand growth is coming from, and peak oil demand is not a conversation that is being had here. It is based, and I made this point to you last year in our wrap up of 2023. You can argue that peak oil demand is already there in Europe and parts of North America, but it's certainly not over here. So it's a busy, busy place. People want to get around quickly, want to make money, want to get rich and enjoy themselves, and it's an exciting dynamic to be part of.
Well, I mean, the demand question is always going to be probably the key driver of oil price this year. It depends on how you want to take a look at the supply side and how much more can OPEC do to goose the supply side of the equation to cause prices to go higher,
Yeah.
which I'm of the camp that OPEC has probably done all they can do without starting to hurt themselves and hurt the lower tier members of OPEC more financially than the upper tier members of OPEC. But nevertheless, I think demand is still not going to be the strong number that when you look at the information that's come out from OPEC on their own global demand forecast, it's probably not going to be as strong as they say it is. And I'm more aligned with what the IEA has to say about demand going forward. So not as robust and as strong, and more of a flat line than anything else.
Yeah, it's I mean, you sort of read between the lines, or OPEC Secretary General Gates last week said, you know, if you look at, there is no robust short or medium term forecaster that sees peak oil demand by 2030, a mere 6 years away. Clearly, there's an issue between the IEA and OPEC. Obviously, they're not one of their basket of analytical companies they look at anymore. I mentioned about the peak oil demand story before. I mean, look, there was one article last week about what OPEC and leverage they've got, and I'm bored about the rhetoric on, is the group dead? Is the group as important as it used to be? Absolutely, it is. I didn't know that their share of global oil supply shrunk to 28.5% instead of 33% a few years ago. So still a drop in the ocean in the grand scheme of things, but a sizable drop nonetheless.
Well, you have all that monster production coming online in South America. I mean, the whole Guaiana production fields are massive, and they're
Yeah,
getting
yeah.
ramping up in production. You still got good, strong U.S. production on top of that, and so with that, you are overshadowing what OPEC can do, and they are losing their dominant position.
Yeah, but the market still reacts to an OPEC headline. I don't know. I mean, look, if if someone within the group wants to increase production, because there are others within the group who do want to increase their production, notably the UAE. You know, they want to be 5 million barrels production by the end of 2030. That's not a long time away. Eventually, UAE will have to increase their oil supply. If that happens, or it's too early yet, of course, but if we've got it happening within the next sort of year or so, you know, it's slowly going to start ramping that up. Do the Saudis step in and pick up the slack and sort of cut by the amount out of the? I'm not sure. I think it was clear last year, seeing that Q4 Saudi GDP showed that it was in contraction, it was in recession, because the agenda is keep prices higher, because they've got a lot to pay out for. They've got a lot of the investment strategies within the country, huge ambitions, as we know. But what does that mean for if they want to keep prices above 80? I think to their detriment of income, they'll have to keep prices high, which means they're going to have to step in. I don't see an alternative. It's compulsory now, you know?
Yeah, but you know, that's just calling, if you're an oil bull, you're looking for the OPEC put at this point. And will OPEC deliver on that put? I mean, they had a dickens of a time getting a voluntary cut across the line, which
Yeah.
has not seen the results of the voluntary cut just yet. But I don't think those will start materializing until we get into February when people start looking at actual January numbers. Um, so that to me is the biggest question on the on adhesion. Do they get the 2.2 million barrel voluntary cut, or is it something less than that? My guess is they're probably trying to hold the line on the 2.2 million barrel cut, but the recent issues in the Red Sea are making it where it's a bit tough to do so.
Yeah. I mean, that is, look, I mean, we managed about 6 minutes into the podcast without talking about the Red Sea. I thought we did remarkably well. But look, I mean, joking aside, it's you know, I've been in the oil industry 24 years this year, and I'm waiting for a carriage clock or something, you know, some kind of gold pen or something for my services to the oil industry. An MBE, a King Charles will phone any moment, saying thanks for your service to the oil industry, Matt Stanley. Yeah, right. I just, you know, what is happening there? What is the gravity of the situation? The issues the maritime world faces in terms of security, what that means for disruption to energy supply. I've never known anything like it. I've got to be honest.
Well, I mean, when you look at it from a pragmatic point of view, because I'm nothing but pragmatic when it comes to these types of things, you know, just like when the Western nations cut off the access or they stopped importing in Russian oil, and there was a hue and cry about, oh my God, the market is going to go devastatingly bad. Russia's going to have to shut down all of its oil production because they won't find markets. And within about 4 weeks, the world went, oh, wait, actually, Russia's found all the markets and we've just rerouted all the oil supplies and the market's rebalanced. And oh my God, there's been no real impact. Now, the Red Sea is basically the same thing because it's not every ship is being impacted by the terrorist attacks by the Houthis against vessels transiting the Straits of Bab el Mandeb. You know, they are targeting who they want to hit. And so the people who are under the target list have moved their ships out. They're no longer transiting that zone. But you still have vessels transiting that zone that are not impacted by it, i.e., you know, from what I can see from the data that I've seen, Russian oil and any other cargo ship that is coming from the Black Sea, Russian ports, or other ports that are not affiliated with the rationale behind the Houthis is moving without a problem through the Red Sea.
Yeah, Bahri is still moving ships, the shipping arm Aramco, but it's becoming more and more profound in terms of the number of ships that are not going through. So last week,
Well, sure, but what does that actually? I mean, so it has increased ton miles. It has,
yeah,
but you know, from the net impact of the oil trade, it really hasn't done much except increase the time of a ballast passage on some ships, and it has increased the lead time of supply on some distillate.
yeah,
And that's pretty much the impact. Everything else is unchanged. When you look at VLCCs, most of your VLCCs would go around Africa anyway. They
yeah, I
would.
know. Okay, but look, if you're saying that, I agree with you, and that's why prices haven't really been affected. There is no tangible effect in terms of supply. There's not a pocket of supply that's affected as such.
Well,
The question,
I'm not saying there's supply is not impacted. There is some impact to supply. And I think the majority of that impact sits within the distillate frame, not so much the crude oil frame. Because when you
yeah,
look at the LR1s and the LR2s, which are medium to large size clean product carriers that would load out of India or the Persian Gulf, Arabian Gulf, would go through the Straits and go through the Suez Canal to hit the markets in the Europe.
yeah,
Now, if those ships are no longer transiting that route because they find it's too dangerous, they're going around Africa, which is
yeah,
adding 15 to 18 days of supply lead time for those
yeah.
cargoes. So there
No,
is,
no, but like you said, that will quickly adjust itself because people will
yeah,
get used to how long it's going to take. I think the question that most people have got is, okay, let's say, because last week we saw no LNG vessels transiting the Red Sea. The first time in a long time we've ever seen that. Before really the LNG market was a traded market. It's the first time we've seen that. So that's LNG. A lot less ships, LNG ships than tankers or dry cargo, but it's significant nonetheless. Let's say tankers follow suit and they say, right, no cargo, no oil cargo is going to transit the Red Sea at all. What do the Houthis do then? Do they say, oh, great, we can sit back now? That's it done. Or does the conflict spread? Does it become a wider issue? I think that's what people are worried about.
yeah, but where's the where are the Houthis going to go then at that point?
Well, I'm asking you.
I'm asking you because as a rhetorical question back
I'm
to you.
asking you.
I mean, they're in, the impact of the Yemenis land against the Straits of Bab el-Mandeb. It's a very small piece of land, and that's why it's a pinch point in global trade.
Yeah.
If you lose a target group that you've been targeting, then what can you do? Shoot at Navy ships?
Well, that's what I mean. I think that's the question that people have got is it's this ambiguity that's
Well, I don't
being
think it's
reflected in why
ambiguity. I think the
prices
fact
refuse.
that they basically lose the fish in the barrel, and now they just have a barrel with no fish. And
But
so
what's to stop them going, do you know what? Let's widen our search. Let's go, let's I don't know, move the conflicts. This is what these are the questions I'm being asked by
yeah,
lots of
but
different people.
how so the only other place that they could probably do something would be the Straits of Hormuz.
Yeah.
Because that's really the only other pinch point where they could have some type of reach. And if that happens, that not only hurts them, or not, that not only is widening the impact, but also hurts their benefactor, Iran. And
Yeah.
so I don't see them doing that because that would just be, in my mind, that's a suicide mission.
I totally agree.
So
But
once they lose the fish out of the barrel, and now there's nothing else, they have no targets for them to justify to go after, they basically lose their impact. And the
yeah.
market readjusts and away we go. But again, this is probably the reason why crude markets can't get above $80 at the moment.
Yeah, that's what I was saying.
Like all
Is that
the strife in the Middle East, there is a finite set of vessels that they can attack that can just reroute, and also they don't have that finite set of vessels anymore.
yeah. And I think it's that because I remember having this conversation with you probably 2 years ago. Oh, there's no way that, you're a bit more open, should we say, to discussion. But certain people I spoke to, there was no way that Russia were going into Ukraine. There was no, that just wouldn't happen. And here we are nearly 2 years later, and it's still very much a problem. And there was an oil depot hit over the weekend, St. Petersburg. What does that mean for gas supply? Market muted reaction. I think people now are sort of not surprised. Would they be surprised if there were the conflict spread wider within the Middle East? And I bloody hope it doesn't. Trust me. And I wanted to use a more aggressive expletive, but it's a problem the market's got. But oil markets don't seem to be pricing anything in. I just think there's something even more dramatic needs to happen. And I feel like I've said the same thing for the last 2 weeks. You were a poorly sold last week, so we didn't have a little session. But it just concerns me that it's a wait and see. $78 on Brent is refusing to go higher or lower than that.
Yes, well, I mean, when you look at the chart on crude, I mean, we basically have been in this sideways pattern since November. Which is kind of amazing. I mean, if you look at a high at 80, a low of 74, there's your range. And we've been in that
Yeah.
range since November 8th of last year.
But March, if you look at backwardation, March, Sep, what contract are we now on Brent? March, right? So March is M1. So you got March, September Brent, it's like $2 backward. So people are pricing in some issue when it comes to supply more than they were a couple of months ago.
Well, yeah, no, and I think that's where the risk premium is probably sitting. It's not setting in the flat price, it's actually setting in the time spreads. Because if there was anything that
Yeah, maybe.
would cause a disruption to flow, what would react more? Yes, you'll get a move in the flat price, but you'll get a larger move on a percentage basis wise on the time spreads. And that's where a lot of people can put risk on without having too much value at risk measurement against them. So being
Yeah.
front end time spreads is a valid trade at this point. And that's just keeping an upward bias in the market because until that gives up, you do have support from a price
Talking
overall.
about prices. Yeah, talking about prices, can I indulge for a moment? Not Edwards versus Stanley, because we did that. We know who won last year. We're talking about the oil price forecaster.
I would call that a draw, but
Oh,
anyway.
um, sorry, I'm choking on something. What is it? Bullshit. That's what it is. Is Kepler the best price oil forecaster for last year? Look, and I'm going to take my hat off to Victor and the guys. Some brilliant colleagues. Everyone on that team, Homian and Florian, and Matt Smith. It was tough. The job of an oil forecaster is tough to say the least. And if you're going to forecast, you should forecast often. That's always the same between them. But look, last year we forecast an average Brent price of $84.50, and it came in at $82.50. So I think that is within the sort of percentiles of pretty much spot on. We've come out with our forecast for this year for 2024. Don't say anything yet, Russ. I can see you're itching too. Just shut up for 1 minute. We reckon for the average daily Brent will be $81.13. Now, to put that into context, where does that sit within our contemporaries, with our competitors? Bank of America at the highest at $90 a barrel. And we've got poor old Citibank sitting there on the bottom of the pile with $74 a barrel. Look, I mean,
Those
that's a
city
pretty
guys, those are pretty smart.
those city guys, yeah. Ed Morse's legacies. Oh, no, come on, boys, asked me to come back because I was right. No, good lad he is. It's a fairly narrow range. $74 from one, $90 from the other. I'm obviously Barclays got 85, EIA suspect 82. Goldman's recently downgraded its call to 85. So we've come in $81.13. We expect the first half of this year to be tangibly weaker, both in terms of market sentiment towards oil, as well as actual flat price staying in the high 70s for most of the spring maintenance period. It will only be the usual summer tightness to nudge Brent back on an upward trajectory, ending the year slightly above 85, but with an average of 81 this year. So look, that's credit to the crew guys. They're brilliant. Read their articles, reach out if you can't get them. They're very, very good. And I just want to commend them for, I mean, I can't, the anxiety they must have going, oh my God, I said it would be 80, but it's trading at $98. But your integrity is questioned all the time. So, credit where credit's due. The boys did really well. And the girls, Victoria as well. She did a really great job.
Well, I mean, it is when you look at the forward price forecast, which you do have, the wide variety of what is supply and demand going to look like going into 2024. You've got on one hand, the OPEC side, which shows, stock draws throughout the entire year of about 1.2 to 1.3 million barrels. And then you have the IEA showing stock builds throughout the entire year of about 500,000 barrels. So you do have amongst the governmental organizations a wide variety of where's oil going to go, who's right, who's wrong. And I think if you start
Yeah.
looking at all the different other analysts that come out through the banks, through the financial institutions, through a Kepler, they're going to have a wide variety of ideas of what's going to happen. I mean, some are showing that Q1 and Q2 will be very loose, Q3 will be very tight. Some are showing the other way around. So it is a interesting point here in January that we're looking at forecast for 2024 and trying to glean, okay, where is the actual supply and demand going to be? I mean, if
Yeah.
OPEC believe their own press, they would think that right now crude should be $100 because their demand is so strong and they've cut so much supply that markets should be really, really higher.
And where is it? Where is it? 78. Let me guess. 78.20.
Yep, 78.20, right smack dab in the middle.
It's amazing, really. I mean, like I said, I put this on my daily oil commentary. And I know you have as well. Is that you would be forgiven to think reading the news and all the sort of drama that's been put around it and hyperbole that's been put around every journalistic piece when it comes. I know it's their prerogative to do that, but for waking up and sort of looking at your screen thinking, well, based on what I'm reading, it should be 100. And I'm pretty sure that OPEC are sort of going, yeah, it should be. Why isn't it? It should be. Everyone else is wrong.
Well, that's because demand is not as strong as OPEC thinks it should be. That's why.
Yeah.
I mean, we're back to the whole demand question once again. You started off this whole conversation today about, oh, there's no peak oil demand. Oh my God, demand is so great. Yet we're still at $78 with
No, I know.
gradually
Look,
reducing supply. So if supply keeps coming off and prices don't react, that tells you demand is not as strong as people are equating. So peak oil demand, we're probably right in the middle of it right now.
yeah,
Global
mate,
peak oil
well,
demand.
we have this argument every bloody week. All right, let's not have it this week. Um, but
All I can say is flat price is showing me this.
well, it's a different. You're sitting there in Geneva. I'm sitting here in Kuala Lumpur. It is noisy out there. It is busy out there. Everything's been built in Geneva, isn't it? Not building stuff.
Building is one thing, but when you have all these nice little EVs running around that nobody's buying gasoline. I mean, when you actually look, when you look at the stocks of gasoline in the United States, because that's probably the best data you have right now.
Yeah.
We were talking this time last year, and oh my God, stock levels are so low. You have pad 1A, oh my God, it's empty. Pad 1B, empty, oh my God. And that's the reason why gasoline is so strong. But when you look at the current US petroleum stocks, gasoline is now 7% higher than the 5-year average.
That's a lot as well.
3% higher. Jet fuel, 4% higher. When you start thinking in those terms, where is the demand? In a major 330 million people in the United States, and you're building stocks of gasoline at an exponential rate because the demand is not there. Granted, there have been some weather issues here in the last couple of weeks, but nevertheless, demand is not there to drive it because there is a shift in the demand profile. You have efficiency gains on engines, and you've got the EV revolution all joining together to reduce the demand profile across all your consumer fuels. And nobody wants to fly because cost of jet travel has gone through the nose.
In the words of Derek and Clive, I'm not going to have this argument again, Mr. Hastings. Okay? Look, let's talk about supply. News this morning, Russia leapfrogged Saudi Arabia to become China's top crude oil supplier in 2023. Now, how do you think that sits in the offices of Riyadh?
Well, that's the reason why they cut the OSPs, trying to get that market share.
Okay, that's a very good point, and that's something I raised this morning as well. How aggressive do they need to get? On what net back are they looking at? Are they looking at price cap? Are they looking at where flat price sits? Were they looking at diffs? Are they looking at grey? I don't know. $2 a barrel was significant because it was a 27-month low for the Saudi OSPs for February. What does that equate to compared to where Russia are selling? And if they want to take back their market share spot, which of course they will want to, how much will they need to discount their crude to compete with Russia?
Well, you got to remember, though, it is a different grade of crude versus the Russian crude. And, a lot of what China is bringing in is irrelevant of price cap, right? So, they've been importing majority of the ESPO flow as it comes out of Cozumel into China. That's always been above price cap as far as I can tell from the data. It's never been below price cap. So they're bringing all that crude in, plus they're bringing in anything else on the long haul. So I think price cap is actually an irrelevant data point. I think what is more relevant is what are you getting from the yield profile of the crude. Saudi crude versus Urals versus ESPO. And that's where the majority of the debate comes into play. And that's going to be a function, to my mind, of what does China have for export quota for product and
Right.
what they need for crude coming in to meet that export quota so they can maximize their own internal revenue when it comes to refining margin.
So okay, that's interesting because lots of people they sort of look at when they hear a Chinese export quota story, those within the market as well as outside of it, look at the export quota story and go, I kind of don't understand. Right. So what you're saying is that in order to understand inputs, i.e., the amount of crude oil they buy, look at the export quotas on what the output should be. So let's say, for example, they were allowed to export, the refiners in China were allowed to export, I don't know, 40 million tons of gas oil last year. This year, the export quotas are 44, 10% higher. So you're saying they should be buying more distillate rich yielding crudes.
That would be my assumption.
And what would you say? So a Urals or an ESPO distillate yielding crudes?
They are heavy sour crude, so they do have a higher distillate yield. Uh,
Right.
plus they have a large residual yield. So you can't just take that distillate cut as one piece. You have to also look at that
Yeah,
40% resid yield,
of
and
course.
you have a place for that 40% resid yield. And it's a high sulfur resid yield. It's not a low sulfur resid yield.
That's interesting. So I'd never looked at the export quota as being a proxy for demand, essentially,
Well,
because
it's where do they put the marginal barrel to maximize revenue? Assuming they're running their refineries as if they want to maximize profit. So
okay,
you have your internal demand inside China, which means they need so many tons, so many million tons of gasoline, gas oil, resid for whatever they need the resid for, bitumen for
yeah,
the roads. And then they have what's left over they can export out to the world.
okay. Because Jushan, last week we saw just sticking on export quotas, etc. Last week we saw some data come in for what bunker demand looked like globally, right? And Singapore, number one spot, reached 5 million tons a month in Singapore in December. I
Yes.
mean, I don't expect the smoking barrel nation to start popping cork saying, woo, 5 million tons, but it's significant because,
Well, it's significant, but in the framework of a Red Sea
yes,
avoidance,
yes,
that's where that comes from.
yes. Now, what we also saw last year was Fujairah lose its number three spot, so it's no longer on the podium, to Zhoushan in China. Now, that is more significant to me than any other story because as much as people look at Chinese data, which we're talking about now, import demand, proxies, working the figures the other way, i.e., how much you're going to export means how much you're going to import and where you're going to get it from. We're here to think about these things, people. You know, that's why we love you, TSB Nation. But no, it's what they also are doing as well is building infrastructure, building new trading hubs where ships can go and bunker that are calling China instead of using Singapore. So Singapore have gained market share from probably Gibraltar, the Med, and Fujairah. And Zhoushan are taking some away from Singapore. So it's really a good story for East of Suez.
Well, let's see, the Zushan could also be taking demand from the West Coast United States as well.
Right.
Because you got to remember, most of your container traffic runs on a loop system, so you have that
Yeah.
whole Pacific route looping, where you have Chinese goods being loaded, going into the U.S. West Coast, being discharged, coming back into China to reload again, and you could be siphoning away from the U.S. West Coast because when you look at the U.S. West Coast from a bunkering perspective, you have lost suppliers in the U.S. West Coast because the market is relatively crap when it comes to a bunker supplier into shipping. So you
Well,
don't
that's
have.
because yeah, it's because of California regulation. Did you know, right? Did you know you can't operate a coal or wood-fired oven pizza restaurant in California because of emissions regulations?
Yeah.
Bullshit. I'm not going to get into it now. It's a whole other episode to talk about that, but because everyone knows I'm a PCOLO, pizza master. But okay, that's an interesting one. So, it's these changing trade patterns, isn't it? And it's the whole going back to where we started. I lost my sort of thread.
Well, it's a
When we
change in
started
trade
with China.
patterns, but you got to remember also when it comes to bunker fuel in California, California has a special tax regime around bunker fuel. So if you bunker in California, you pay a consumption tax on that fuel to the state of California until you hit your next port of call outside of California. So having a place where you're bunkering in, so that basically kills demand in the country, in the state, and shifts it to other places. And so China becomes a very interesting point because there you do have a refining base, there you do have cheap production of goods, and you're on the same routing. Therefore, you can bunker up your ship fully, make it through your Westpac run, and voila.
California, the state where you can buy marijuana, no problem. But if you want a ton of bunker fuel, then you get screwed. That makes perfect sense. Sorry, enough of anti-US.
As a California native, it is called the land of fruits and nuts for a reason.
I saw DeSantis pulled out of the Republican race and has endorsed Trump this morning, by the way. Does that, just sticking on the US while we're in it, 13.1 million barrels production a day. Do you see that changing?
13.3.
13.3. 13.3, mate. Do you see that changing anytime soon? Energy policy changing with elections coming up end of the year?
I really don't because, again, the US is more of a decentralized production than you have any other country in the world. It is all sitting in the hands of private entities. So I don't see that changing at all. I mean, I think the biggest impact you're going to have to the US and crude oil is going to be basically the TMX pipeline, which is coming online in Q2. It passed a significant regulatory hurdle, and now they're allowed to finish the work to get the pipeline through the mountains. And they'll start doing line fill. And they'll put heavy sour crudes that normally would go through the U.S. Gulf now directly to the West Coast. So that's going to be a big change on crude oil flows coming up. But when it comes to U.S. policy, I don't see any real change to U.S. policy because, like or lump it, the U.S. oil patch is a huge, significant driver of jobs.
Yeah. Yeah, I mean, look, I hope no one from Greenpeace is listening. I mean, I probably are because, they're secret smoking barrel lovers. But if you've got big oil, US energy policy, consolidation in the sector, people protecting jobs and building more jobs, and those profits going to fund the renewable energy sector in the US to offset the carbon emissions program in the US in general. Well, I mean, it's the irony of ironies, isn't it?
Well, it's not there, but that's part of why it's called an energy transition, not an energy stop. We are transitioning away from petroleum-based fuels to other fuel sources, but to use the revenue from petroleum to fund that shift makes a lot of sense because you still have consumption of gas oil and diesel and jet fuel, just not as much as there was 10 years ago, but it's still there. And so as long as you can keep siphoning those cash flows away to fund your other research and your other production.
Yeah, but hang on. If you're a Chevron and you're not, your internal demand, and here we go again, I've got to answer this conversation again. Your internal demand within the US is diminishing, but you can build your trading book, create more jobs, optimize to sell into cargo into Brazil or Paraguay, because that's where the demand is, then you're just again, it's this change of demand hubs, demand centers. It's not the US anymore. It's shifting to the growing economies, to the middle.
But the growing economies are nowhere near the same size as the OECD. So therefore, let's have the same demand profile. Therefore, you have a reduction in demand.
God, he works for the IEA, doesn't he, this boy? Jeez, talk about someone's tired. Jeez.
And when those people start adapting to alternative energy sources because they realize, oh, it's better for me to do that versus do this, then voila, 102 million barrels a day. That's probably where we're going to be for the next 5 years on demand.
In your next episode of the the smoking barrel, look, come on, this lunch at Kuala Lumpur won't eat itself. So let's wrap it up.
Yep. Well, I think that's all we have time for today. Look out for your supply and demand numbers and click like and subscribe and tell all your friends. We're live on YouTube, we're live on Spotify and on LinkedIn.
Yes, sir. Good to see you.
As always, thank you for all your help last year, Irene, and looking forward to working with you still this year. And we love you, and we will talk to you all later.
Ciao.